Welcome to our latest podcast. I'm Derek Barrow from Santander Asset Management. I'm joined today by our Global Head of Macro, Tactical Asset Allocation and Alpha, Haydn Davies. Hello, Haydn.
Good morning.
So let's get straight into it. Markets have been very volatile over the past few weeks after the failure of Silicon Valley Bank and Credit Suisse. Is the worst behind us, and are there any consequences for the economic outlook?
I think it's certainly very interesting that 4 weeks ago, this time last month or so, none of us had heard really of, or very few of us had heard of this little bank, Silicon Valley Bank in the US. And its collapse has subsequently sent ripples throughout financial markets and indeed the banking system. And of course, we've had the takeover of Credit Suisse as well in the meantime. Of course, what we've seen in the last few weeks is investors get nervous about the losses that banks have on their bond portfolios. And banks aren't unique in this. Anyone who held government bonds over the last year has incurred losses because interest rates jumped very sharply as central banks raised them in order to rein in inflation. So banks have losses on their government bond portfolios. But what has distinguished Silicon Valley Bank, and in this sense it's unique and not in any way representative of the rest of the banking system, is just how big its government bond portfolios were. Banks are generally in the business of taking in deposits and making loans to households and companies. Silicon Valley Bank had a very small loan book. Instead, it was in the business of taking in deposits and investing them in government bonds. And that sounds a lot more like a hedge fund than a bank. So SVB was unique, and its problems definitely are not symptomatic of broader woes in the banking system. Credit Suisse was a different case. It was actually a relatively healthy bank, a very badly managed bank. Its shares had fallen, I think, 75% over the last 5 years, and that's before the turmoil over the last few weeks. And it had been hit by a series of scandals, had to pay several fines over the last few years as well. So the Credit Suisse's problems were not that it was illiquid or insolvent, it was just a badly managed bank. Now, banks across the banking system, particularly so in the US, have incurred losses on their government bond portfolios, but that's normal. And they're very well capitalized these days. That's a result of the reforms that were instigated in the wake of the global financial crisis back in 2008. So we think that banks are in much better health than the current, I suppose, turmoil in markets would have you believe. And we don't think that the collapse of SVB is about to spark off a much broader cascade of failing banks in the US or indeed elsewhere. But markets are going to remain nervous for the time being, and they're going to look to see if there is another domino that could fall. Certainly, we would think that the current focus on Deutsche Bank seems very misplaced. Again, it's a very healthy bank, not in any way like Silicon Valley Bank. And whilst market nervousness is understandable in the circumstances, we do think that perhaps markets have overreacted. Now, that said, there will be consequences of the collapse of SVB, and there will be other bank failures. In any normal year, a few US banks fail. It's just like any other industry. But because there's been a sort of run on deposits and depositors have been taking their money out of US, particularly the regional banks, these are the small regional banks, not the big city centre banks that we've all heard of, the likes of JP Morgan and Bank of America. Because that has been happening, it means that the regional banks will have to cut back on their lending and tighten their lending standards. And that's important because these small banks account for about 2/3 of the lending in the US. So we are going to see a tightening of financial conditions in the US over and above what has been engineered by the Federal Reserve in raising interest rates. And so as a result of this, we would expect a sharper economic slowdown than otherwise would have been the case. Banks are obviously a very important part of the financial system and have a unique part to play in the economic transmission mechanism. So all said and done, the turmoil that we have seen, whilst we think it perhaps is an overreaction, it is going to have economic consequences. It is going to result in weaker economic growth than would be the case, and increases the risk of a recession later in the year. Now, we have been arguing for some time that a recession is what it's going to take to get inflation under control in the States. But certainly this financial turmoil and the tightening in credit standards that banks will pursue as a result of this certainly increases the risks of a deeper recession than we've been expecting, and certainly seems to be increasing the expectation amongst economists that there will be a recession.
Excellent. Thank you for the answer. So this week, the Bank of England raised interest rates after inflation rose unexpectedly in the UK. And the US Federal Reserve also raised interest rates despite concerns about the health of small regional banks, as you've just discussed. How much further will the Fed raise interest rates? And does it face a choice between taming inflation and supporting the bank system? And also, what is the outlook for UK inflation and interest rates?
Perhaps let me just start by answering the question you raised about, is there I suppose, a conflict of interest between taming inflation and supporting the banking system? And the answer is no. Central banks have different tools to address inflation, and they have different tools to support the banking system. So in the space of the last couple of weeks, we have seen the Federal Reserve raise interest rates, but at the same time extend a long credit facility to banks so that they can borrow reserves from the Federal Reserve, borrow cash from the Federal Reserve, using their portfolios of government bonds as collateral. And those loans are for a year, so they don't have to worry about paying them back in 3 months' time or so. And this is just to ensure that banks have sufficient liquidity to meet any demand from depositors for deposit withdrawals. So that improves the liquidity of the banking system. But at the same time, as I said, we saw the Federal Reserve raise interest rates 25 basis points. Now, of course, about 6 or so weeks ago, the chairman of the Federal Reserve, Jerome Powell, had indicated that they were thinking about raising interest rates in bigger increments. And so the market had been expecting a 50 basis point move this month, or even a 75 basis point move. Of course, that was all before we had the turmoil that the collapse of SVB started. So certainly the Federal Reserve has had to back off a little bit more than expected, and that's because it thinks that the stress that the banking system's coming under, the fact that depositors are taking money out and their bank accounts and putting it to work in money market accounts instead, is going to force banks to tighten their credit standards, and that will send ripples throughout the economy. And in particular, there are concerns over lending to commercial real estate companies because the small banks account for a disproportionate share of lending to those companies. And indeed, the Federal Reserve alluded to the problem this week that in its statement that tightening financial conditions is what it wants in order to bring down inflation. But of course, it doesn't want to tighten the screw too much. And certainly tightening financial credit standards, which what banks will do, they will make it harder to get a loan, will have that impact. It will tighten financial conditions, but there is the danger that it tightens financial conditions more than the Federal Reserve had been expecting through just raising interest rates alone. And so central banks are getting nervous that this is what we're going to see. Banks had already been reporting that they were tightening their credit standards. So the ECB, the Bank of England, the Federal Reserve, they all conduct quarterly surveys of banks to ask what's the demand for loans and what are your standards? Are you making it harder or easier to get loans? And all of those surveys had been indicating that banks were making it harder to get a loan. And the turmoil that we've seen in recent weeks will only make that worse. And so central banks will be nervous about that. And that indeed is one of the reasons why actually the markets think that the Federal Reserve will not raise interest rates any further, and indeed might actually be cutting interest rates by the summer. And certainly looks as if the Federal Reserve will have to step back now, given the turmoil that's been unleashed by the collapse of SVB. In the case of the UK and the Bank of England, well, the inflation number that came out this month was a shocker. There's no hiding that. And of course, it really did make it very difficult for the Bank of England to do anything other than raise interest rates, despite the market nervousness. However, inflation should fall quite sharply over the course of this year. So inflation in the UK is still above 10%, and in the US it's 6%. In the Eurozone, I think it's more around 8.5%. So UK inflation is high by the standards of other countries, but because energy prices are falling quite sharply, we should see that feed into headline inflation. So natural gas prices, which obviously have been in the headlines an awful lot over the last year, are about half of what they were this time last year. So we should see energy prices stop pushing up inflation and actually contributing to falling inflation. So the Bank of England feels pretty confident that inflation will be falling by the end of the year, and economists expect inflation to be around about a little bit north of 3% by the time we reach December. So in that sense, the Bank of England doesn't have to do too much more in terms of raising interest rates in order to bring down inflation. Now, what all the major economies have in common, though, is that core inflation, this is the phrase that economists use to describe inflation that ignores the impact of energy and food prices, which are very volatile. Core inflation is still very stubborn, whether we look at the US, the Eurozone, or the UK. It's running at a level of about 6%, which is much higher than central banks would feel comfortable with. And that is forcing them to still think about raising interest rates, or even against the backdrop of the turmoil from the nervousness in financial markets around the banking system at the moment. So in terms of the UK interest rate outlook, the Bank of England faces a difficult choice because inflation is still, on the face of it, things much higher than its target, but it expects inflation to come down quite sharply over the course of the year. So on that basis, the markets are expecting another quarter point 25 basis point rise in interest rates at the next meeting. But a lot will depend on the next inflation print. But after that, it thinks that Bank of England's basically done. And indeed, the Bank of England was giving those kind of indications when it raised interest rates at its most recent meeting.
Excellent, thank you. So against that volatile background, how are we positioning our portfolios at the moment?
Well, it's certainly not easy when markets are this volatile, but certainly our view has been that there will be a US recession this year because that's what it takes to bring down inflation, not so much that that's what we were forecasting. It's just because we think that's what the Federal Reserve has to engineer. As far as the outlook perhaps for government bonds is concerned, we had moved the portfolio to overweight government bonds at the end of February on that basis that we thought that the interest rate cycle was coming to an end. Yes, central banks still had further to raise interest rates, but the end was in sight. And that's done very well because of the turmoil in equity markets. At the same time, bonds have rallied quite sharply. Now, at these levels of bond yields, we think that maybe we want to pause on adding to our bond positions, and possibly we could even take some of those profits. That said, the outlook for bonds over the next year or so probably looks quite positive. It's just whether we could potentially tactically take some profits and buy back bonds at better levels, because certainly bond markets have been pricing in quite sharp cuts in US interest rates, which we think is a little excessive in terms of what is likely to come from the Federal Reserve. As far as equity markets are concerned, it's difficult because we do expect a US recession, but at the same time, most economic indicators are in exceptionally rude health, whether we look at the US or the Eurozone, for example. So we've had business surveys of business confidence, which are very good lead indicators of economic activity. They've been very bullish, particularly in the service sector. The manufacturing sector, less so, but in the service sector, that still seems to be very, very strong. So the global economy doesn't look in too bad shape at the moment, which on the face of things would be good for equity markets. And of course, that's one of the reasons why it's been difficult for policymakers to bring down inflation as quickly as they would have liked. So on that basis, whilst we think there might be further economic weakness, maybe 3 to 6 months from now, at the moment, we'd probably say that equity markets are reasonably priced. The US market isn't pricing recession, but they're reasonably priced given the economic backdrop, and they're certainly better value than they were a month ago. So on that basis, we're sort of neutral to a little bit overweight. We prefer the Eurozone and the European markets at these levels to the US, but certainly thinking a little bit further ahead, we would think that markets will be a little bit lower at some point this year than they currently are. But in the short term, we would argue that markets have overreacted. So difficult in the current environment, but certainly trying to play the opportunities tactically and take those opportunities as and where they arise.
Excellent. Thank you, Haydn, for such a detailed update. So thank you for listening to our latest podcast. The views expressed in this podcast are the views and opinions of Santander Asset Management UK and do not constitute investment or financial advice. If you want to explore more of our views and insights, please visit our website at santanderassetmanagement.co.uk. If you require guidance or advice, we would recommend you contact your professional financial advisor. Thank you once again for listening to our podcast, and we look forward to speaking to you again soon.